important to consider things like, would this borrower be willing to borrow under these terms? Would it be able to borrow this amount of debt? Would it be able to service the debt? And do those parties actually perform the functions connected with these important points, important risks at times? And for the lender, you'd also look at things such as whether there would be alternative investments that would be more favorable. Is this investment something that a third party would be likely to do under these terms, or should some of the terms be reinterpreted in the context of the accurate delineation of the transaction? This is also called considering the options realistically available by the OECD. So you would look at what other options were available to the investor, to the lender, and also to the borrower attracting funds. Next slide, please. Could we move please to the, yes, thank you. So when we talk about the functional analysis here, we would also look at a number of things, such as, importantly, the financial forecasts. Before you grant a loan, you would look at the financial impact of that loan. Do you have enough income to cover your interest expenses? Do you have a capital structure that would allow to attract this debt in terms of equity, but also in terms of assets? So we look at things as loan to value, besides loan to equity. Interest coverage ratios are things that would be relevant here. And aside from the purpose of the loan, and the whole investment horizon in relation to the loan. So what is the loan actually financing, and what are the expectations from the borrower and the lender in relation to that? So this would translate also into the terms and conditions of the loan agreements, whether there's any third-party debt alongside intragroup debt is very important. Other board documentation or other relevant documents used. Investment prospectuses for funds, for example, and the positions, for example, the positions of key group personnel are things that you would look to map in the context of the functional analysis. We will come back to the conclusion of the functional analysis later on, but now if you could move on to the next slide, please. So once you have, so the functional analysis, the outcome of the functional analysis is to obviously map the functions, assets, and risks of the parties, but the conclusion is also in relation to what is the functional profile of the parties. Once that is established, you may look into the selection of the transfer pricing method. The general rule and of the OECD guidelines is that the most appropriate method should apply, and you may apply more than one method corroboratively. So you may have a primary method and a secondary method to support, to evaluate the intergroup prices. And that could be as a matter of price setting for an investment that hasn't been done. That's the best case scenario, or as an additional check over time. For example, let's say that an investment a loan has been granted in a certain year. You can come back to it some years later and check whether the investment is still at arm's length. There's moments where you may want to revisit your analysis because the economic cycles have changed, or there's any other reason why any of the parties would wish to readdress the investment. So, for example, from the side of the lender, whether there would be any breaches of the obligations of the borrower, or whether there would be a significant risk that the borrower wouldn't be able to repay the loan, a risk of default. Or from the borrower side, for example, better financing conditions. So the borrower might refinance to attract lower interest rates or more debt, for instance. In terms of the transfer pricing methods, you would look into applying an internal cap comparable uncontrolled price method. That means that you would look for, the CAP puts a lot of emphasis on the characteristics of the loan, and you would look for a loan that is broadly comparable to the intragroup loan in terms of the key features that have economic impact. An internal cap means that one of the parties to the intragroup loan would also have granted a loan or received a loan from a third party, whereas the external cap would be simply finding a comparable from other sources between unrelated parties that has no connection with your transaction. Other approaches mentioned in the guidance include a cost of funds approach that is particularly relevant for intergroup treasury companies that are sort of in a position comparable to a financial institution, such as a bank. Realistic financial projections are also relevant and can be used in connection with economic modeling. Here, there's an important caveat that bank opinions are generally not relevant for pricing purposes, because a bank opinion is just a quote. It's not an actual transaction, and the OECD requires that you are comparing your intragroup transaction, your control transaction, with a third-party transaction that has actually been entered into. Next slide, please. So this takes us to the very important concept of comparability. You may find sources for comparables in external databases, but also in different types of external financing to the group. It's really important that whenever you're looking at intergroup loans, you don't ignore potential third-party debt that could qualify as a cap, as a comparable uncontrolled price. So if there is any external debt, that doesn't mean that your intergroup debt will necessarily have the same terms and conditions or the same interest rate, but ignoring that and not analyzing those transactions in the context of your transfer pricing documentation is a huge risk, because otherwise, for taxpayers, that is making the case very easy for the tax authorities to challenge their arrangements. Things like official credit ratings on bonds issued to the market are also very relevant for pricing intergroup loans, and I'll come back to the ratings in a moment. Next slide, please. So a few points about determining interest rates on loans, because these are rather important. Is one of the primary points of the analysis in terms of the transfer pricing evaluation to be done, and there's a few important points. Interest rates are depend on a number of features that may be economically relevant. Some of the most important are the maturity term of the loan, and here there are interesting dynamics where, in general terms, you would expect that the longer maturity would represent a higher interest rate, and that's generally true. But in recent years, we've seen inverted yield curves happening, where in the short term, you would find actually higher spreads than on the long term. Those are special economic dynamics that we're living in these times, and put an emphasis on actual comparability and require a lot of care in looking into these matters. So interest rates typically have two components. One is the spread that really represents the risk or reflects the risk of the borrower, and there it's safe to say that the higher the higher the risk of the borrower of lending to that borrower, the higher should the spread be, in combination with other factors such as the maturity terms, such as the moment when the loan is granted, because economic cycles have a big impact on the interest rate. And then the second component is the base rate. The base rate may be floating or fixed, and for fixed rates, often swap interest rates are relevant. For the spread, there's a measure that captures the risk of the borrower rather well for our purposes, or that is often used as a measure for risk, for lending risk, and that is credit ratings. And that allows, and next slide, please. That is a good move to the next slide. So what factors affect the credit rating? There's issues such as the geographic scope of the income to the borrower, issues such as what currencies are involved, the industry sector and specific aspects affecting the industry sector. Um, some credit rating agencies take a lot of well, obviously the credit rating when it's performed and when there's an official credit rating by a credit rating agency, those should not be disregarded. Those are often more accurate and take into account a wide number of things. Aside from that, often taxpayers may look at financial models to try to estimate the credit rating of an intergroup borrower when uh, other information is not available. And this could be done in many ways. It could be done through models that reflect, that use financial ratios together with some multiples for the geographic scope in the industry. But in addition to that, you may have you may determine, for example, the interest the credit rating based on the terms and conditions of an existing bank loan through what is called an implied credit rating analysis. There's a number of tools to estimate credit ratings, but these are just some of the points relevant affecting ratings. Maybe we can move on to the next slide, please. So it's important, and this is one of the aspects that the current guidance clarified on intergroup loans, is that uh, the starting point, the most accurate starting point, is to assess the credit rating of each borrower independently. Uh, if there is a group rating, that is relevant, but it's not sufficient to assume that all entities of the group would have the same rating. So it's the most accurate approach would be to try to estimate the rating of the borrower and then see whether the rating of the group could have any impact for a third party lender. And that is because, and of course, that rating would have the rating of the group would definitely affect the rating of a particular borrower if there's an explicit intergroup guarantee, a formal guarantee. But even if there isn't one, uh, a third party lender may be willing to take into account that a certain borrower is a member of a group, provided that entity is considered strategic. Core strategic is the term used by rating agencies. And maybe we could move on to the next slide. So there's a number of criteria that rating agencies take into account to assess whether a borrower would be considered to be core strategic, and therefore have basically that means that there would be an expectation from a third party lender that the parent of the group or the group as a whole would intervene to aid financially a borrower in case of distress, even though there's no legal obligation to do so. That's called implicit support. And effectively, that can mean that the standalone rating of a borrower may be notched up a couple of notches as a result. And there is some guidance on this from credit rating agencies. And there are some references in the guidance, in the OECD guidance of Chapter 10 now, that well, shed light on the limits of those and when is it appropriate to rely on those. But credit ratings remain a very, very useful tool to estimate the risk of the borrowers. And we may move on to the next slide, please. There's a few other important factors to consider. Broader comparability, so things like the effect of macro and microeconomic aspects, the options realistically available to both parties, and also transfer pricing documentation includes a three-tier approach with master file, local file, and country-by-country reporting. These things may also be taken into account in addition to industry-specific factors. And maybe we could move on to the next slide, please. And this is my closing point, saying that, reminding that in addition to evaluating the arm's length nature of interest rates, the amount of debt is also on point. So it's relevant to consider whether the amount of debt is at arm's length, whether that borrower would be willing and would be able to attract a certain amount of debt. And this could be evaluated by, for example, comparing the loan to value. That means the amount of the debt in relation to the amount of the assets of the borrower with third parties that are in comparable circumstances, and in other factors such as interest coverage ratio or debt to equity. Those could be all useful elements to support or to evaluate the amounts borrowed.
Thank you, Gaspar, for this very technical expose, and I'm sure our audience has had a very fruitful session knowledge on the OECD guidelines on intercompany loan. I will now look at a case study involving a treasury company. So in this case, I will look at both from a lender and borrower perspective when intercompany loans come into play. So here we look at the OECD guidelines as to whether a purported loan should be regarded as a loan. Purported loan here means what appeared to be a loan, whether in reality that in fact should be regarded as a loan. The OECD refers here to whether debt and equity funding of a borrowing entity that is part of the same M&E group differs from what would have existed if that borrower, for instance, was an independent entity operating under same or similar circumstances. What we have here is that the amount of interest payable by the borrowing entity, whether this is actually impacted, how the interest is impacted, and how its profit is impacted. When we look at a situation like this, what the OECD says, they don't only emphasize as to whether the interest rate provided on an intercompany loan is at arm's length, but also whether a prima facie loan can be regarded as a loan or should be regarded as some other kind of payment. In particular, for instance, whether that loan to the related party borrower is indeed a contribution in the equity capital of the borrower. So in this scenario, what we need to consider very importantly is whether a third party would be willing to provide the entity here with a 10-euro loan. So if the company, for instance, the borrower has a history of financial difficulties, I mean, for me, the obvious question is, would the company still be around in 10 years' time? And here, if the borrower is entering into a 10-year loan agreement, 10-year loan agreement to finance or to manage its short-term capital needs, whether a third party would be willing to lend on that similar term. So to depict how much of a loan should technically be regarded as a loan, what we need to consider, for instance, is given the financial health of the entity, what would be the maximum amount that an unrelated party would be willing to lend? Or if the third party lender would be willing to lend at all. What would be the terms of the loan? What would be the duration of the loan, for instance, and the repayment term? So in this case here, hypothetically, if I'm looking at the 10-year loan agreement and say the borrower borrows, say, 100 million from a related party and paying interest of, say, 5 million per annum. In this situation, if a third party lender, given the financial situation of the company, would only be willing to lend half of the loan amount, for instance 50 million instead of 100. So the remaining 50 million would probably be treated as a contribution to equity rather than a loan. So likewise, in this case, probably not all of the 5 million interest payment would be treated as deductible. So in this scenario here, probably half of the interest payment, for instance, 2.5 million, may be disallowed and treated as a dividend instead of interest. So it's very important. So just by having an intercompany loan at a particular amount and a particular interest rate doesn't necessarily mean that if the tax authorities applies the OECD guidelines, that the whole amount will be treated as a loan and the whole amount will be tax deductible in terms of the interest. So now I will hand over to my colleague Christos, and he will look at the functional profile of a treasury company. So over to you, Christos.
Many thanks, Feroz, for your insightful presentation, and for you, Kaspar. Now, what I will be explaining right now, that will be a practical case study. In these slides, we depict effectively the different types of financial transactions that we see in practice, and of course, they are shown in the financial transaction report of the OECD, which is effectively the intra-group loans, cash pooling arrangements, hedging, financial guarantees, and any other financial services. So all these different types of functional profiles that MNEs typically identified in treasury centers. At the end of the day, we need to identify them and remunerate them. As we already know, in transfer pricing, it's all about function, asset, and risk, the abbreviation of FAR. Yet, in the 2017 transfer pricing guidelines, risk is a king. So we are effectively remunerating risk and less assets and less functions. And that's why we have the three columns saying you are the agent. If you are the agent, it means that you are risk limited company, and therefore you are remunerated very low, risk-free rate. Where if you bear the risk, you are remunerated more. And if you're a strategic treasury company, you are effectively a full-fledged risk company, and you receive more remuneration. Next slide, please. Now, in this slide, we are explaining our case study, the various considerations that an MNE will consider in practice when choosing a location, when to locate this treasury center. It's very important for Mauritius. I mean, all these are considered as a tick box, as a checklist. When an MNE would look for a treasury center, it's very important you have a reliable legal system, low withholding taxes. You get the interest expense as deducted. Review your capital structure. What is your corporate tax rate? So all these are considerations that the MNEs are looking for when they would like to, of course, effectively choose their location for doing their treasury activities. Next slide, please. Now, to get into the practical depth, this is a practical case study that we see on our day-to-day practice. So assume, for example, that a treasury company would like to finance its activities, and to finance the investment, they need to raise 100 million of US dollar. For each investment, you have 5 investments, so you need 500 millions of US dollars. Typically, from our practice, we have seen mainly 2 types of injecting money in a company. This is equity or debt. Of course, there are other means like derivatives, but for simplicity purposes, our example here is equity and debt. And then when you raise the money, let's say the 500 millions, you provide the finance to you push the debt down effectively to your subsidiary. Now, from what we have seen in practice, is that if you receive the money as equity, this transaction does not fall under the transfer pricing rules. The shareholder injection is free from transfer pricing. So effectively, if you receive the money as debt from a related party, this means that your interest expense might be disallowed. So you need to price the debt on an arm's length basis. And then when you are going to effectively lend the money to your related party borrowers, you need to price those transactions. As Gaspar mentioned already, and of course Feroz, when doing so, we effectively assess each borrower differently. So it's similar to a test that a person goes to the bank and say, good day, I want to receive a loan, and the bank will make a creditworthiness of that person, how credible that person is, what are the terms and conditions of the loan. So we effectively make a creditworthiness of each subsidiary of each borrower. We provide that borrower to a specific credit rating, like what credit rating agencies are doing. And based on that credit rating and based on the terms and conditions of the loan, I mean, are there any covenants? What is the maturity? What is the any guarantees on the loan? We identify arm's length interest rate for such borrowers in order to price the loan at arm's length. So we're using effectively the CAP method, which is the preferred method from the OECD. It used to be explicitly stated, but now it's implicitly stated. And this is a methodology that we're using. Of course, if the loans are back-to-back from related parties, we also using the CAPM method and the expected loss methodology in order to price also the interest payable at the capital structure of the company in order to price the interest expense as well. Of course, if the debt is from a bank, so you receive a bank loan, it means that this is from a third party. So this is outside the scope of the transfer pricing. And what we are doing is just pricing the loan receivables and not the loans payable, because the loans payable are effectively from a bank and this is a third party. Next slide, please. Now, this is a general discussion with my colleagues Feroz and Gaspar. From our experience and what we have seen in practice is that the tax authorities nowadays, and especially after the publications of the financial transaction report in 2020, they are more aggressive on challenging financial transactions. And this is because now they have a guidance. They know how to price the transactions. They have official guidance. In the past, they didn't. They were effectively performing tax audits on financial transactions based on their own experience and based on experience that they received from other tax authorities. However, now the OECD, by publishing the report, they have all the experience that they need and the guidance they need in order to challenge the transactions. And the main issue that we have seen in practice is that because transfer pricing guidelines are published as guidelines and not as hard law, soft law, they tend to have a retrospective application. So what does this mean? If, for example, they publish the guidelines in 2022 and you are effectively running a tax audit in 2017, the tax authorities we've seen in practice is that they say, yes, but you should have followed the transfer pricing guidelines. And this is arm's length. And the report that although it was published in 2020, you should have done the same way to achieve an arm's length because the arm's length is the same. Arm's length is arm's length. So if you have failed to follow the OECD publication, it means that you will end up with an adjustment. So we have seen this in practice, and it's very important for the taxpayers to follow the transfer pricing guidelines and not wait, I will say, at the end of the day, after the tax audit will come, because it will be problematic. I don't know, Feroz or Gaspar.
Talking about the retrospective aspect, Christos, I mentioned the Section 75 in the Mauritius Income Tax Act was amended. And when we look at the amendment, it actually said it's effective from the date of the commencement of the Income Tax Act in Mauritius. So the in or from Mauritius. The changes was effective from the date of the beginning of the Income Tax Act. Now, in Mauritius, the Income Tax Act was introduced in 1995. So there was a concern whether the tax authority would actually go back to a transaction that happened in 1995 or 2000, now in 2022. However, in Mauritius, the tax authorities can issue a tax assessment, they can ask for information in the current year of assessment and the preceding 3 years. So there's an argument that even though the law was effective when it was amended as to the commencement date, but technically the MRA could only go back the current year and the 3 years of assessment. On another note, you've mentioned about financial transaction from the OECD, and today we're talking about intercompany loans. So maybe you could elaborate a bit more about the other types of transactions that the OECD talks when they cover transfer pricing for intercompany transactions.
Yeah, so other transactions that you have seen in practice, Feroz, of course, the back-to-back loans and the intra-group loans are the majority of the transactions that we've seen in practice. Is also a cash pooling. So a company, a big M&E, acts as an in-house bank, and they pool all their bank accounts in one centralized cash pooling center. So they are make the payment centrally in order to get better cost efficiencies and of course better rates, because if you are in overdraft in one country and you are in a deposit in another country, you don't get that. So for charges and for bank charges and for interest expense, it's more efficient to do your cash pooling. So we have seen this in practice. Also financial guarantees. A subsidiary would like to get a loan. However, if you don't have a guarantee from the parent or either their name or their credit rating, you may get a better rate from that local bank. So we have seen this practice as well. And what else I would like to add on this topic is that, and it's a new paper coming, it's the overlap between the financial transaction report and tax treaties. So for example, that under Article 11.6 of the tax treaties, only the arm's length amount is eligible for treaty benefit, and taxpayers that they follow the financial transaction report, effectively, they are in a position to defend themselves that they are bulletproof for a treaty perspective in order to get the whole amount as eligible for the withholding tax, and the tax authorities in the source state will not deny any withholding tax because you have a transfer pricing. We are expecting this to come in this year, maybe next year, and I will say that taxpayers that they have a transfer pricing study following the financial transaction report will be bulletproof from a treaty perspective as well.
Okay, so transfer pricing is not just to defend the interest rate when it comes to an investigation by the tax authorities. It's not just to defend the deductibility of your interest expense in your tax return, but also to benefit from a reduced withholding tax rate when you're paying the full amount of interest. Otherwise, you could have a reduced withholding tax under the DTA on only a portion of the interest, and you would have to basically withhold a bigger amount on the other portion of interest, which is not deemed to be arm's length. Having said that, in your opinion, Christos, you've probably done a lot of transfer pricing study. What would you say, from an OECD perspective, would probably be an acceptable interest rate on intercompany loans? Is there a range that we could be considering?
Yeah, typically, Feroz, countries have in their policy, if if they want to provide an incentive to the taxpayer, they have safe harbor rules with high margins. Let's say, for example, 2%, we have this in Cyprus and in Luxembourg. The 2% is the margin between, the difference between the interest expense and the interest receivable. However, these safe harbor rules tend to be very high because the tax authorities, they say, okay, give me a very high margin and I will be happy, you don't need to do a study. So I will say a high margin will be at 2%. Based on our experience and experience from other countries. But on back-to-back loans, a margin is never 2%, especially right now that the interest rates are very low. We have seen financial transactions with margin like 0.5, 0.3, 1%, something like that. But going to a 2% margin, I will say maybe this is high, in particular, right now that with this financial crisis, interest rates are very low. I mean, we see central bank in Europe, they have negative rates right now. So take into this consideration, financing via back-to-back loans, we experience low margins. And this means that the MNEs, they can finance their activities via intra-group loans and not via bank loans with more efficiently because they pay less interest, less charges because the bank will charge you back charges and it's more flexible.
Thank you, Christos. I think we're nearly running to the end of this webinar, but just before we go, just one last question. Like we've mentioned, we don't have a formal transfer pricing legislation in Mauritius. So at the moment, we don't have any TP documentation that we need to submit to the Mauritius Revenue Authority. So in your opinion, when we have an intercompany loan between Mauritian entity or foreign entity, on top of the normal loan agreement, what other documentation, in your opinion, would you advise the Mauritian entity to have in hand in case it gets queried by the tax authority?
You know, Feroz, there are also clients that they might not be required to have a transfer price documentation because they are not above the threshold, but for best practice they do, because, you know, typically a transfer pricing study involves a cross-border transaction. So even if, let's say, for example, the tax authorities in Mauritius do not challenge the transaction, maybe the interest paid from, let's say, for example, India will be challenged from the Indian tax authorities. So a transfer pricing study between a transaction between Mauritius and India will be advisable in order to protect and to avoid any restriction of interest expense in India or deny withholding tax. And to come to your question, also a transfer pricing study will provide you adequate advice on substance because you have your transfer pricing study, but when you do your transfer pricing study, it's like you are having a health check on substance because you will see your remuneration on your length, and this will be based on your substance and how you are remunerated. So transfer pricing substance is very important. And on top of that, I would say that when we are doing transfer pricing studies, the client will also be able to review his activities. And if the client is weak on substance, he will be advised in order to enhance the substance in Mauritius. And this will be shown by a transfer pricing study because as you and Feroz, and Kaspar mentioned in the beginning, you have to do the delineation of the transaction, the functional profile, understand the company. And when you do all this, you will understand what extra substance you need to be placed in Mauritius, what extra documentation you need to do, any other activities and decision making. This will effectively assist you placing more substance if needed in Mauritius to safeguard your activities.
Definitely. Thank you, Christos. It's been really helpful. We have the key takeaways on the screen. And obviously, we will be sharing the slides with all the attendees after the webinar. So, Gaspar, maybe a final word from you. and Christos afterwards before we close this session.
Thank you. So I would say that having Chapter 10 in place, meaning financial transaction guidance, and in particular for intergroup loans on transfer pricing in the guidelines, is very relevant because it gives it a legal status which is that of the OECD guidelines, and emboldens tax authorities to use that guidance, but also allows taxpayers to understand what is it that they need to look at. And so, since the guidance is there, it's an invitation for being proactive. Also, because there's increasing the number of countries that prioritize price-setting types of analysis, so looking towards the future rather than looking backwards at transactions that have already been put in place. It's always difficult to explain the past if there wasn't an intention based on a TP understanding. So these things have broad implications for multinationals in the way they structure themselves, and in particular for treasury companies. Obviously, there are many points where the guidance could have been more detailed, and those elements will still be probably completed, or we'll get more information as more cases will be fought around the world in courts. And in any case, there is a lot more practical guidance than there was before. And so maybe just a very quick point on COVID to say that aside from this, having guidance on COVID together with the guidance on intergroup transactions allows us to really be much more informed about current trends and how TP is applied under current trends.
Thank you, Gaspar, and thank you again, Christos, for joining us on this webinar. I'm sure, like myself and all our attendees has really found this really fruitful, and we've all benefited from your knowledge and expertise. A particular big thank you to my colleague Faraz Jafour, who's basically planning this webinar, organizing it, and a big thank you to Yadav, who's actually put all the slides together as well. So thank you very much to the whole team, and thank you for all the participants to attend this session. And we look forward to seeing you on our future webinars. So thank you very much and have a nice evening. Thank you. Bye-bye.
Many thanks for the invitation, guys. Take care.